Okay, sounds like other people can hear you. So I'm just going to start talking and then pass it over to you, and hopefully I can hear you later. So I'll get started with the presentation here today. And thanks for Judy and John for allowing us to present. My name is Jamie Lane. I'm Senior Director of Economics and Forecasting and Head of Hotel Research here at CBRE Hotels. And what I'm going to walk you through today is our current outlook for the industry. It's no surprise probably for anyone on this call today that the hospitality industry and overall economy has been derailed by this pandemic and has completely ended this economic cycle, where we've gone from 60-year lows of unemployment now to 90-year highs as of April. At CBRE, we've got data going back to the 1930s, and we had to look back to 1938 to find revenues this low on an inflation-adjusted basis. And that's back to the Great Recession that we see, and this shows our current expectations for 2020, where we expected 2019 to come in, and then compares going back through time how real levels of revenues came in for the industry. Moving into explaining where we think we're going to go to here, it's helpful to understand what's going on in the economy. And we're now seeing it from two sides. One, a supply shock, and the other, the demand shock. So first, supply. And this is showing just the levels of shutdown throughout the world. It's not just the U.S., but pretty much every country worldwide that has seen some levels of shutdown. And this is a chart from Goldman Sachs that shows an index level of shutdown comparing countries of where they're at today and where they've been. And you can see just the extreme levels of shutdown that they're at in Italy, in the UK, where that compares to where we're at here in the US, and then where China was and where they're at today. So you have seen an easing of shutdown throughout China, and that's showing up in total economic output. Key to making projections today and feeding into those supply or shutdowns is what's going on in the current pandemic. And what we've done here is shown an index 7-day moving average of net new cases over the past 4 months. And you see the peaks that China hit in early February. It'll be interesting to align that up with occupancy when we start comparing overall hotel performance. So just make note of early February, where Italy was at their peak in late March, and then where the U.S. apparently has hit peak as of early April. Now, if we went and line up each of those countries by their peaks, you can see how quickly many countries were able to bend the curve down. Debatable whether the data from China is believable, but we do see how quickly Germany and Italy have been able to sort of bend the curve down, and then where the U.S. And United Kingdom are still at or near peak levels of daily new cases. And this gets into the first set of assumptions that we're using to make predictions today. And I won't pretend that we know what the future holds, but only that we're relying on sort of the experiences that we're getting from other countries and what the scientists and epidemiologists are predicting. and using those to inform a set of assumptions to come up with a range of predictions for the hospitality industry. But one of those key assumptions is that we start to reopen to travel 8 to 12 weeks after the peak number of new cases. That's what we saw coming out of China. That's what we expect to see in Italy. They're just now beginning to open back up certain aspects of their economy. Even as today, I'm sitting here in Georgia, we are now able to go to restaurants, movie theaters, and are starting to see opening back up of our economy. But looking at the overall economic picture, we are at in recession, and we got Q1 data today, negative 4.8% in Q1. We expect further decline in Q2, and then a slow movement of overall economic growth moving into Q3 and into 2021. We don't expect today a V-shaped recovery. Our current expectations are more of a U-shaped, and we will be at a much lower level of total economic output coming out of this recession than we were pre-COVID-19. But we are expecting a recovery today in GDP, nominal recovery in mid-2022, and that aligns up with our employment projections as well. As I said, there's a large amount of uncertainty given these outlooks. So I'm going to talk about a range of potential recovery scenarios. And looking at the hospitality sector, I would definitely put a bias towards the downside scenarios as we look at these numbers. So our baseline scenario anticipates roughly 24 million jobs lost in Q2 2020, and that's as a measure of total non-farm employment. So I know we've already seen 30 million new unemployment claims. Not all of those jobs are measured in total non-farm employment, so we're still sort of in the realm of our current expectations, pushes unemployment up well over 15%, but also government stimulus, fiscal and monetary policy begins to or keeps financial markets open and supports the overall recovery. Our downside scenario anticipates a more prolonged recovery where employment levels don't return until 2024. And then on our severe downside scenario pushes that out more towards past the 4-year recovery and into 5 or 6 years to get back to 2019 levels of employment. And this sort of visualizes those scenarios in relation to past recessions. So we've got the 1990 recession in green, 2001 in light green, 2008 in blue, and then our current baseline scenario in magenta. And you see we are expecting a much quicker overall recovery than we saw in the great financial crisis. But as you move into our downside scenario, that does very much follow the slow, gradual recovery that we saw really from 2011 through 2018. And then how much longer it takes a full 6 years to get back to pre-COVID-19 employment levels. How that impacts the U.S. economy is not even. It's not even by sector, and it's not even by city, given their exposure to those sectors. Us here in the leisure hospitality business are getting impacted the most. We're expecting Q2 output in the accommodation and food service business to be down over 90%. And that is clearly what we're facing today, with RevPARs down well over 80% and down 90% in some sectors of the economy. Moving now into the hotel data. So this is showing weekly and daily occupancy since the beginning of February. And here it shows two things. One, the complete collapse of hotel demand. And it was over a 2-week period from the beginning of March, where we were still at mid 60% occupancies, till the back half of March, where we got down to 20%. That was a period of just 2.5 weeks that we saw travel essentially dry up. But we do see that occupancy levels are stabilizing. They've even increased slightly. But it's important to note that even in the past 2 weeks, as occupancies have stabilized, on a year-over-year basis, over this past week, we're still down roughly the same amount as we'd seen in early February, as the spread between last year and this year has stayed pretty stable over the past 4 weeks. We do expect over the next really 2 months that we're going to stay at these low occupancy levels. And we're monitoring a variety of high-frequency data points to find those green shoots. Does it look like and drive-to leisure demand is starting to pull back? Do we see people coming back into restaurants? Are people starting to make forward-looking bookings again? Across all of those, and I would say there's some. In open table restaurant data, just the past 3 days, we have seen a small amount of people start to come back to restaurants in Georgia and Tennessee. Across many of the southern and western states, we have seen some trips on weekends between 50 to 100 miles away from home. But we have not started to see any real increase in forward hotel booking volumes or airplane volumes as of data yesterday. So where does the U.S. compare? And this shows occupancy levels over the past few weeks and compared in lining up countries from when they first started seeing major declines in occupancy. And here you see and China's about 5-7 weeks ahead of Europe, 7 weeks ahead of the U.S., and that they are now, last numbers came in at 35% occupancy, up from well below 10% back in early February. Throughout Europe, where we're still in high levels of lockdown, we're still well below 10%. But as that starts to ease, as we expect over the next few weeks, we do expect some demand to start to return to those markets. How does that play out in terms of an overall timeline for our forecasts? And this shows some of the key assumptions here of and 8 weeks past that peak puts us at mid-June. That's when we first expect occupancies to get over these low 20% figures. We expect some initial return in demand as domestic drive-to, some corporate demand comes back. But then it's going to be a long haul to get back to pre-COVID numbers. And it really depends on whether or not we get a vaccine or major treatment that allows inbound international travel and group and conventions to come back in any meaningful form. I note that this data is all from STR, which I would put as pretty trustworthy for at least the U.S. chains reporting how their hotels are performing. And they have come back relatively quickly, given that the overall levels of occupancy are now at 35%. Across the U.S., this is impacting different types of hotels in different ways. Now we're showing occupancy levels by chain scale. And you see the higher the ADR, the higher the impact. So luxury upper upscale hotels are now right around 10%, while economy and mid-scale are operating at a significantly higher level, averaging about 30-35%. Those hotels are able to accommodate a much higher number of essential type demand, whether it's medical workers, quarantine patients. Transportation industry is still up and running, supporting the U.S. supply chain. And then long-term housing, extended stay hotels, people that are getting pushed out of their long-term housing and needing hotels for short-term residential stays is still being used. Hotels are still being used there. Rates are still decelerating, and we see overall declines anywhere from 50% for luxury hotels to 20 or 30% in the lower chain scales. All of this data is being influenced by the overall shift in demand towards lower rated properties. So while the national ADR drop is almost 45%, it doesn't mean that the average hotel has dropped their rates by 45%. Just that the average rate paid drops by 45%. And given that economy and mid-scale hotels are making up such a larger percent of overall demand, it's going to skew the numbers downward. We've also seen a high number of closures. No surprise there, given the hard operating environment we're in today, where more than 50% of hotels in the luxury and upper upscale segments have closed. So we're using all that data to come up with projections. We're still using experience from past downturns. So this shows the recoveries from Toronto and after SARS, 9/11, great financial crisis and the tech bubble. And here we're able to inform our outlook by the time it took them to recover and how quick they were able to pull back demand once restrictions were lifted. Our current outlook today calls for a 46% decline in RevPAR nationally, and a full 3 years before nominal RevPAR is able to come back to 2019 levels. As I said, there's a large amount of uncertainty in those projections, maybe larger than I've ever experienced. The disparity between our upside and downside scenarios, a full 25%. So our downside looks as estimates of minus 57% for 2020, and our upside at minus 32%. This shows our current projections relative to past hotel cycles. So peak or pre-recession RevPAR levels indexed how the hotel industry performed over the subsequent quarters. And you see in both the 2001 and 2008 recessions, it took roughly 15 to 18 quarters to fully recover RevPAR. Our current expectations is 13 quarters in our baseline scenario, but our downside scenario, which is very much a real possibility, pushes that out to 24 quarters, or a full 6 years. So a wide range of potential recovery scenarios, anywhere from 3 to 6 years. And that does vary greatly. It does vary greatly within our markets that we forecast. So we forecast the top 60 cities for the U.S. In these markets, we see a range of anywhere from minus 60%, and the markets that rely most on international and group and convention travel to as little as minus 40% in some of the smaller drive-to leisure-oriented markets. And that's a combination of both how steep their drop is and how quickly they're going to be able to recover demand as we start back on the upcycle. And just this final slide takes a look at our baseline expectations and bringing that down to profits. So for full year 2020, where I'm even operating at these levels, many hotels aren't going to be able to make a profit, and overall GOP and EBITDA levels were significantly higher as of end of 2019. We're already seeing today roughly 100% decline year over year in profits, and which makes it very hard to operate a hotel and supports many of the closures that have happened, especially on the upper end, given the high fixed cost of operating those properties. So I'm at time now, so I'm going to switch over and pass the baton to Dan.
Well, thank you, Jamie. Can you hear me now? Jamie still doesn't hear me. Okay, Jonathan Albano told me he hears me. Fine. Just bear with me 1 second here. I'm going to share my screen. Bear with me 1 second. Okay, hopefully everybody can now see the screen and can hear me. Yes, looks good. Great. Jamie, thank you. Thank you for your presentation and for passing the baton over to me. Judy and Jonathan, thank you for the invite. I'm flattered to be asked to present. So the title of my presentation, I believe, says an awful lot. And I know Jamie just said 2.5, maybe 3 weeks. I kind of look at it as just 4 absolutely shocking weeks of unprecedented downturn. Excuse me. And by the way, before I move on, I know there's been a lot of questions about getting copies of presentations. If anybody wants a copy of my presentation, my email address is in the lower left-hand corner. So just jot it down real quick. Daniel.lesser@lwhadvisors.com. I'd be happy to send it to you. All right, let's just take a real quick minute. Everybody knows this. This is nothing new, but just to sort of set the backdrop a little bit about hotels and what makes them unique. And I've done a number of these webinars over the past couple of weeks, and lots of commercial real estate folks that dabble in more than hotels. But it's important to remember that hotels are operating businesses. There's no credit tenancies. Inventories are sold every single night. The pricing of inventory, with technology being what it is today, changes by the nanosecond. You have a lot of compounded complexity in terms of multiple parties that are involved in a hotel investment, and there's usually a good chance that underlying interests are not necessarily aligned between an owner, equity, lender, property manager, brand, et cetera, et cetera. Very high leveraged, high fixed cost business, irrespective of whether the hotel is 10% occupied or 100% occupied. And then reliance on intermediaries, right? I mean, I think it's pretty evident today, right? If the airlines don't start flying, we're not going to be putting heads in beds. So just setting, again, a little bit of a backdrop here, nothing new here, right? Really kind of amazing. We had a 10-year run of record metrics from a room revenue perspective, and then also from a profitability perspective. And then, of course, coronavirus hit, and this is as of yesterday. There's been over 1 million cases in the United States with more than 59,000 deaths. It is important to note that the concentration of the activity is in six states. And, of course, this is yesterday's headline. First proclamation that I've seen that we're now officially in a recession. And then, of course, we've heard from Arnie Sorensen, we've heard from Chip Rogers that what's been going on over the past couple of weeks is according to them worse than 9/11 and 2008 combined. What I find interesting is in the lower left-hand corner, Oxford Economics, along with U.S. Travel Association, came out with a proclamation that the impact that we're going through is 9 times greater than 9/11 in terms of travel sector revenue. I mean, that's just astounding when you think about it. And then, the AHLA, who's been great in terms of, getting out there and advocating for the sector, has announced that unprecedented job losses in the sector. So this table contains the similar data to what Jamie showed, except what I want to highlight here is that, again, if you go back to that the table that showed 10 years worth of growth, right, and then by December was an all-time high. January increased at 2.2%, another all-time high. February increased at 1.7%, again an all-time high, and then it just fell off a cliff, right? And we can see, March 1st. The week of March 1st, the second week, the third week, and by the fourth week, RevPAR down by 80%. And the last 4 weeks, it's just sort of bouncing around at right around negative 80%. So I believe we clearly are at the bottom. The question is, when do we, mathematically, I don't think the numbers can get much worse. When do we start moving up? And then, this is interesting, and it shows, major markets that just got clobbered. San Francisco, horror show, Seattle, Anaheim. Out of these handful of cities, Oahu took a little bit longer to take the hit, but obviously, after 4 weeks, it took a dramatic hit. And this is just a visual of, again, showing 4 weeks of decline. And then ultimately ending up at, bouncing around at negative 80%. I find this very remarkable. This is also from Smith Travel Research. Out of 645 submarkets that Smith Travel STR tracks by month, in March, every single one of the 645 markets experienced a decline in RevPAR. Again, these are astonishing numbers. And then when you look at this on a quarterly basis, again, totally mind-boggling. Of course, the hotel industry has always been pretty good at this, developing rooms. And we last month in March, we hit an all-time peak of hotel rooms on the construction. Great timing, right? Unfortunately, but it is what it is. I think it's safe to say that a fair number of hotels that are currently or were currently under construction may actually not be completed, and if they're completed, they may not be completed as hotels. And then this next slide is also quite illustrative. I mean, when you look at the negative, almost 52% decline in RevPAR, right, and compare that with 2008, compare that with 2001. And then go back all the way to the early 90s, right? I mean, again, this is just absolutely unprecedented. Never seen this before, and it's quite astonishing. When you look at the by class, economy on a relative basis has held up pretty well, which sort of makes sense, as opposed to luxury at the other end of the spectrum, which has taken more of a hit. And as everybody is now saying, the recession's here. Incredible, right? March 2020 compared with last year. I mean, astonishing 51% decline in room revenue. And I find this table interesting too. Again, this is STR's information. Since 1987, the lowest level of absolute occupancy ever recorded was 54.6% during 2009. And this year, STR is projecting 37.9. Again, absolutely remarkable. What I would like to point out in this table, though, is that particularly from a valuation perspective, sometimes I've run over during different times in my career folks that can't understand and comprehend how the value of a hotel could increase 20% in a year. Right. Well, it's all about cash flow, right? And just like revenue per available room may decline 51% this year, obviously hotel values will also or have also declined, right? If in fact STR's projection of a rebound of 63.1% next year occurs, just as fast as values decline, they can rise on a hotel. And again, that goes back to the whole nightly leasing, no credit tenancies, and ability to change average roommates by the nanosecond, which in an up market, it's a beautiful thing. In a down market, it'll kill you. So as we all know, hotels are doing the best they can to keep the lights on. And there've been a number of stories about all types of hotel assets, from Four Seasons at one end of the spectrum to select service on the side of highways in America, being used for alternative temporary uses, whether it's emergency housing for first responders, for those folks that are quarantining, homeless, which is a huge issue in a lot of the major urban areas. And the Four Seasons in Palm Beach was taken over by Citadel Securities, who set up a trading floor, which is kind of interesting. What have the large publicly traded companies been doing? Well, they've been shoring up their balance sheets and drawing down on credit lines. The bottom line is that cash is king today, and all the large entities are flush with cash and hoping to have enough to ride this out. And then, of course, the loan delinquencies are starting to pile up. The table on the lower left-hand clearly shows that. And in the CMBS world, the special servicers are getting inundated at this point. And there's only more of that to come. Some other things that are going on, hotels that are, again, trying to stay open. They're pitching corporate folks that if they want to get out of their house and not have their kids and dogs screaming behind them while they're doing work, come to the hotel, rent a room for the day, and set up shop there. Airbnb and RXR had a deal here in New York to collaborate and create a 200 hotel unit style facility at 75 Rockefeller Center. That deal's been nixed. The Hotel Buckminster in Boston, beautiful asset, 1,000% location, has shut down, and ownership has announced that it will not reopen as a hotel. And again, I think you're going to see more and more of this. New York is another good example where Invariably, there were a whole slew of assets that were at the edge of the cliff on January 1st. They obviously fell off the cliff since then, and I think it's safe to say that a number of hotels in New York will not reopen as hotels. It's going to have to do a lot also with the union contracts and what, if anything, occurs with those contracts. Of course, the sharp elbows are coming out, and we're starting to see all sorts of lawsuits being filed for a variety of reasons. The Anbang Mireille situation is quite interesting because I frankly thought that deal had closed, and I was not aware that it had not closed. And so apparently Mireille is hiding behind the COVID scenario and not completing the deal. Blackstone's got a suit going on where KS Development has claimed that because of Corona, the world has changed and they're not able to pursue at the same cost basis. And from what I've read, apparently there's nothing in the PSA that says anything to the effect of a pandemic. So a lot of folks are watching that lawsuit to see what happens. And then there's a little bit of a wage battle going on in Manhattan. Kind of an interesting story. We got the union, Highgate, and Meadow Partners as the owner. So another interesting lawsuit that folks are looking at. So that's all the bad news. Here's some good news, right? There's a lot of smart money out there. There's a lot of dry powder out there. We hear that all the time, right? And a lot of this smart money is betting on the travel sector, right? Blackstone and Starwood taking significant positions in extended stay America, which is quite interesting. The Saudis stepping up and making a significant investment in Carnival Cruise Lines. Airbnb, we're familiar with that they got two infusions of $1 billion each. Obviously, they had to pay very dearly for that. Expedia, we've heard about that as well. The London Ritz is an interesting story. It's a more than 100-year-old hotel, and on the day that this sale closed is the first day in its more than 100-year history that the operations shut down. The property sold for $997 million. Middle East money, again, just I find it intriguing that, these folks obviously are taking a long-term view and betting on a comeback in the travel sector and specifically the hotel sector. So this is the $1 million question, right? We get asked this every single day. Where are values today? The reality is, the standard answer, as far as I'm concerned, is I don't know, and I really do not know. And anybody who says that they do know, I would venture to guess is making it up as they go along. The fact is that there's no empirical evidence. The market has not spoken. There's no empirical evidence to figure out whether values are down. What I've heard from others, this is not my opinion, but what I've heard from others is anywhere from 5% to 50%, 50. Obviously a very wide range. I was on a call with a couple of CFOs of a handful of publicly traded companies and one from a private entity, and the topic of value came up. And each one of these folks said that they had no idea, and that as far as they were concerned, there was no market. And so from a theoretical perspective, one could argue that there's no value, which is kind of ridiculous because there is value, right? The point being, you got to look on a long-term basis. So market value, there really is no market. And whether it's anywhere between 5 and 50%, I don't know. Liquidation value is a whole nother story, right? Just stepping back a second, market value, the fundamental premise is willing buyer, willing seller, neither acting under duress, right? So no seller in their right mind is selling an asset today unless they have to, right? And which takes us back to the whole liquidation value scenario, which for all intents and purposes, if somebody has to sell and it's an intriguing opportunity at the right basis, and somebody comes along and buys all cash, well, guess what? That's going to be basically a discounted cash flow predicated upon an all equity return without the advantage of debt, which is just not existent right now for the lodging sector, and being able to bring down that cost of capital. This is interesting. Origin Investments is a private equity firm in the real estate space, primarily multifamily and a bit of retail. They're not in the hotel space, but I did find their letter to investors quite interesting, where here are a couple of guys who they supposedly have 50 some odd $1 million of their own personal net worth invested in their funds, so right next to their clients. And on the left, you can see quotations from a letter that they sent out to their investors, where they said they don't know what's going on. Now, if you want to go back to 2001, you may remember that Blackstone purchased Homestead Village Studio Suites. And the deal originally went down in August of 2001 at $900 million was the PSA. Then September 11th happened. The deal got shelved and then ultimately resurrected, and it closed, I believe, in November or December for $740 million. So if you do the math, it's about an 18% decline. Call it rounded 20%. I would not necessarily, hang one's hat on, a 20% decline in value today, but it is a data point. There's one other thing I'd like to mention about September 11th. I know a lot of folks compare today with September 11th, and I'm not sure I would agree. September 11th, in my mind, was a one and done deal. There's so much lack of clarity here as to how long this endures, and with markets and cities opening up on different schedules, what does that look like? Is there a second wave? Is there a third wave? I mean, it's so unclear as to what the near term and frankly the long term looks like. But in any event, here's a data point that you might be able to take a look at: 18 to 20% decline on this deal that occurred in 2001. So Ethan Penner, who runs Mosaic Real Estate, he's known as being sort of the father of CMBS. He's the guy that created it at a time when the capital markets were frozen. This is real estate in general, commercial real estate, and he came up with the CMBS concept. And it's interesting. He was recently quoted as saying that it was a great vehicle for when it was created, but that it was not the type of vehicle that was created to exist in today's world, and that CMBS needs a dramatic overhaul, according to Ethan, and he's probably right. But I find that interesting that here we are, what was that, 94? So we're 20 some odd years later, and still on a platform that was developed quite a while ago, that the founder of that platform is now saying it wasn't built for today, it was built for yesterday. So where are we now? Everybody can read this on their own, but clearly sponsors and managers are in a defensive position, no doubt about that. And then companies that own hotel real estate, in addition to being managers, they're challenged that much further. We talked about hotels visiting with various cities and government agencies to explore alternative uses prior to possibly shutting them down. Constrained liquidity, we already touched upon. And the private markets are clearly flush with capital, and they're in an offensive position, ready to take full advantage of the dislocation. I humbly believe that, listen, let's face it, there's always a fair amount of opportunity out there that doesn't really have a great story, right? I believe that when we do start seeing compelling opportunities that have good stories to them, there's so much smart, sophisticated capital out there. I believe that those opportunities will be bid up, and I don't believe that we're going to see anybody necessarily stealing properties. They're going to pay less than values pre-COVID, but it's not going to be like in the early 90s when hotel assets were trading at literally 10 cents on the dollar. Where are we now? many of the brands have offered significant relief on fees. I know this table's hard to read, but if you want me to send you the presentation, you can blow it up and take a look at it. And then on the right, again, this is in the public domain. We're starting to see evidence of what debt modifications might look like. This is on 2 separate deals. The road back. I know Jamie talked about China. I don't know what we can trust coming out of China at this point, or even early on. But it does appear that they are slowly sort of getting back to business, if you will. I find the 2 slides on the 2 boxes on the lower right interesting. I hadn't heard of this concept of revenge spending and revenge traveling, but with growing middle classes in China having been cooped up indoors for more than 8 weeks, they're apparently outspending lots of money on luxury goods and clamoring to get out and start traveling again. So if you sort of dial that forward, hopefully we'll see that in the United States. Americans are an optimistic bunch. I believe it's Americans also perceive that it's a God-given right to go on vacation, whether they can afford it or not. And I do think we're going to see quite a bit of leisure travel emerge a lot quicker than corporate business and definitely group meeting. And then Marriott and Intercon have clearly announced that. Marriott I think had 90 hotels closed, and last I heard they may be down to 15 at this point. And Intercon has reopened all the hotels that they closed. What are some of the challenges? I'm sure everybody's read about this. The PPP package in many cases is making it more of a compelling story for those that are unemployed to stay home because they're making as much or maybe even a little bit more collecting unemployment than working. And then there's the whole fear of coming back and working in a hotel. So this is, these are interesting challenges, right? If a hotel is closed or even has, a skeletal staff and they want to ramp up, are they going to be able to get employees to come back? And this is going to be an issue that's going to have to be dealt with. I would imagine that the unemployment issue being a better deal than working is going to go away sooner rather than later, but it's there today. So this slide actually comes from a deck that I was using for several years in the past, and I was a germaphobe before Donald Trump was a germaphobe, and I personally never really liked staying in a hotel and found many hotels to be frankly disgusting. And so, the notion of hygiene being an issue in hotels is nothing new. It's been around for a long time, including bed bugs. I think now, obviously, I don't think everybody knows the industry is going to have to react to this because it was a huge issue and it is a huge issue. The AHLA, again, has been at the forefront of advocating for the sector on a variety of issues in DC. One of the things they've been focusing on is stay safe guidelines, and all the major hotel companies and brands are working with the AHLA to come up with standards. And then, of course, each brand family is coming out with their own announcement of what they're doing. Hilton teaming up with Lysol. Everybody's trying to do something different. I think invariably everybody's going to be doing the same thing. Airbnb, I think it's going to be very interesting what's going to happen with them. I believe that travelers are going to become more reinterested in standardized hotel products compared to the recent past when, boutique, unique, what have you. People are going to want to know that there is a stamp of certification in terms of cleanliness in hotels that they're staying at. And so I think it's going to be a huge challenge for Airbnb to compete with that, for the mere fact that they don't have the control that hotel companies do vis-a-vis the actual units themselves. So it'll be interesting to see how that works out. A couple other things, when you look at sort of travel in general, the new normal. I think the picture on the lower left is kind of interesting about what airplane seats may look like. JetBlue has just come out and mandated face coverings for all travelers. So if you don't cover your face, you're not going to get on the plane. Thermal imaging, thermal temperatures, that's going to be all over the place. Chick-fil-A, it's kind of interesting. They're adding hand washing stations to drive-thrus and curbside pickup areas. I wouldn't be surprised if you see the hotel sector picking up on that. Some more of the new normal, definitely no handshakes. I love everybody who's listening to this broadcast, but don't come shake my hand. I'll give you the elbow, but not the hand. Technology. Unfortunately, the sector's been a little bit slow to embrace technology for a long time, right? And everything that you're looking at on the screen here has kind of been around for quite some time. It's nothing new, right? Kiosks, automated kiosks to check in, robots. This is the Aloft robot to deliver items to a guest. Checking in with your mobile phone was previously reserved for elite travelers, right? Everybody's going to get that now. And then, of course, we talked about the cleanliness. On the food and beverage side, I can't imagine that we're ever going to see another buffet again. Maybe we will. I never ate at buffets for the very reason of being a germaphobe. It'll be interesting when wait staff is walking around with a mask on their face. How are people going to feel about that? Obviously, grab and go is going to become much more of a phenomenon compared to what it has been. And mini bars. I think there have been several pronouncements about mini bars going away. What does the future look like? We said it before about New York hotels. Properties, and this is nationwide, properties that were already over-levered or were stressed prior to the pandemic, they're not going to be resurrected and saved by the federal government. They're going to have to be restructured. Capital stacks are going to be restructured, and controlling classes are going to be moving around quite a bit. Obviously, the best located hotel assets and the best quality sponsors are going to be the beneficiaries of initial capital that is sitting on the sidelines. It'll be interesting to see whether independent hotels are going to gravitate more towards soft brands again for that consistency that the industry grew away from, because the traveling public was interested in sort of the unique and growing away from standardization. Again, I do believe there's going to be a tremendous bounce back to standardization. And then supply growth. It's always important to look at supply growth from a net perspective. And there will be many hotels in certain cities that never open. And so there's going to be a little bit of a reset in terms of existing supply in each market. What does the future look like? I believe that air travel and hotel stays, it's going to be two waves, right? The first one's going to be occupancy, or people sitting in seats, right? And then it's going to be rate. Leisure and visit friends and family travel should rebound fairly quickly. Business travel, we talked about a minute ago. Corporate group meeting. I know I, for one, will not be attending any of those anytime soon, unless it's online. Low inflation, should endure, which would keep cost of goods and services low. And then we all know that, energy costs are at some very low levels. So that's kind of a good thing. Biological safety is definitely going to have some permanence going forward. And so I would leave everybody with this saying from Maya Angelou: hope and fear cannot occupy the same space. Invite one to stay. So hopefully everybody who's listening can elect to invite the hope aspect and not the fear aspect. And I'd like to thank everybody for listening. Again, my contact information is on the lower left-hand side. And thank you. I appreciate it.